Okay, so we'll try to be respectful of everyone's time tonight and get started. We will send everyone that registered for the webinar recording in the next couple of days once we get it downloaded off of Zoom. My name is Ryan Johnson. I'm the Director of Investor Relations with GenWealth Capital Group. We'll start off with a little introduction about our company. So we're based in Houston, Texas. All three partners live in Houston, Texas. I live in the urban core city. My partner Juan lives on the west side. My partner Brian lives on the north side. So we're very familiar with Houston. Juan was born and raised in the area, and myself, I've been here for over 22 years. Like I said, we're a Houston-based private equity real estate investment firm. We've done over $120 million worth of transactions since 2016. That translates to about 1,680 units transacted in Houston, Austin, DFW, and Phoenix. We have 5 full cycle deals as either the lead sponsor or a JV partner, and we focus on B and C class workforce housing assets. Juan, I'll let you introduce yourself.
Yeah, Juan Vargas here. I appreciate everybody joining us here tonight. I'm in charge of acquisitions and overall strategy and asset management for the company. I've been investing since 2015, and then in multifamily since 2016. As Ryan mentioned, we are throughout Texas and also in Phoenix. We exited a deal, which we can discuss here later. But yeah.
Yeah, and our buddy Brian's not here tonight. He has other obligations, but he leads the underwriting and the finance. He's the spreadsheet guy, and myself, I'm over the investor relations side of the business as well as construction side. So today, just full disclosure, we're not economists. We're not real estate analysts. We do not have a crystal ball. If anyone knows where to get a reliable crystal ball, we'd be happy to purchase that off of them. But we are going to mention a few topics today. We're going to do a brief 2022 recap on just the economic, tailwinds and headwinds that we had during the year, as well as things that we accomplished over at GenWealth. We're going to give a brief recap of our markets that we invest in, talk about our portfolio KPIs in the Austin and Houston markets, and we're going to discuss just plans we have coming up for 2023. So, 2022 was definitely an interesting year. I would say these two pictures on the left depict it pretty well. And starting in January of 2022, waters were fairly calm. Stock market valuations were high. We had a lot of 401k and crypto millionaires. Asset prices were trading at record highs. I mean, it seemed like, you'd put in an offer and someone would come and just blow past your offer. And sometimes it just didn't really make sense. And kind of fast forward toward the end of 2022, and definitely a lot more choppy waters, a lot of people jumping off the boat, a lot of no more crypto millionaires. So a lot of people lost a lot of money. And, what caused that? And, a multitude of different things. Definitely the after effects of COVID-19, definitely an unprecedented time in everyone's life. Supply chain constraints, massive stimulus spending, an ever tightening job market with rising wages, war in Europe, definitely persistent inflation and rapid interest rate hikes. Housing prices that rapidly elevated in 2022, and then rapidly elevating like mortgage prices due to the interest rate hikes, at the end of the year. Definitely, myself personally lost a ton of money in my 401k. I don't know how everyone else did, but I mean, if you're just in mutual funds and index funds, I mean, overall, the market had a very, a pretty bad year. And overall, that led to uncertainty, right? Uncertainty for lenders lending money to buy houses or apartment complexes, uncertainty for buyers and sellers of apartment complexes and just regular single family homes, and uncertainty for investors in general. So I thought these two charts were pretty cool. I mean, this is the federal funds rate. And as you can see, February, March, that's when the hike started. And then they just kind of persisted throughout the year. And this is interest rates. Inflation. We started January at 7.5. Again, the target is 2%, and stayed persistent. And here at the beginning of the year, it was still transitory, and just a lot of that type of talk from the Fed. And then the hikes, as you can see, just very, very aggressive, very quick, within a short period of time. same chart with the interest rates, and the bottom chart is the S&P 500. And again, very high valuations at the beginning of the year, super choppy roller coaster ride throughout the year, with lots of peaks and valleys. And I mean, anyone that has a large retirement from a W-2 job like myself in a 401k, is definitely a roller coaster ride last year. So for GenWealth, what happened for us in 2022? So, it was a year of exits for us. We exited Tesoro at 12. That was 184 units in DFW. And we exited the Flats, a 237 unit deal in Phoenix. And, I had a colleague of mine was like, where, the returns were so great, and you guys sold at the peak. And I had to remind him that, real estate is a cyclical market, and that's kind of what you're supposed to do, is you're supposed to sell at the peak. So, these were supposed to be 5-year holds. They ended up to be about 3. Overall, great timing from the GenWealth team and other partners on the deal. Lots of challenges in these deals, but overall, they were successful. And if you're looking to dive into a little bit more detailed case studies on each of these deals, you just visit our website, www.genwealthcapital.com. We have some case studies in the portfolio section that you can download on the Google Doc. And we also have a video in the knowledge section just to talk about the business plans of these properties. So on the acquisition side, it was definitely a tough year for us. We screened over 150 deals, toured 49, submitted almost 40 offers. We were in the best and final round 28 times. And for those of you non-real estate investors, the best and final round is basically a round where the brokers try to get the buyers to outbid each other. And it's usually equates to some type of bidding war. We were awarded 3 deals, and we ended up refusing all of them in the end. 2 of them failed, physical due diligence, just because on inspection we found, multi-6-figure inspection related issues that the seller didn't really want to address, as well as one, the debt changed on us kind of mid contract or mid LOI. And the seller refused to lower the price, and so it just didn't really work anymore. So in the end, we didn't acquire any properties, and we were really frustrated. If you own a real estate investment firm, we spend a lot of time in acquisitions. Tons of time. Juan dedicates probably almost 40 hours a week to just acquisitions, deal flow. We have an underwriter that's constantly underwriting deals, and so it was definitely frustrating. But toward the end of the year, we realized maybe we dodged a bullet in a sense. Just because we were seeing some of the deals that we had offered on and lost out on in the middle of the year come back around, and they fell out of contract due to changes in debt most of the time. And they were multiple $1 million less than our original offer 6 months prior to. So we actually had happy hour with some brokers last week, and they were like, hey, I wouldn't let it frustrate you, because it's probably not a bad thing that you didn't win a deal at the beginning of 2022. So overall, it worked out well. We are LPs, we're passive investors as well. So as a group, we invested in over 1,000 units as LPs because we believe in the asset class. We had colleagues, we like their deals, we like their market, we like the depreciation and the upside of the deals. And so we're definitely limited partners as well as general partners.
Hey Ryan. So I want to say something real quick on the 0 acquisitions. Like you said, it looks a little frustrating. It can be a little frustrating, after going through all these deals. We screened 150 deals, and the result was 0. But I do want to add that, it's important to also understand how one can easily manipulate your underwriting, right? Or easily, just try to be a little bit more aggressive on the underwriting to try to win a deal. And you can see there, we were true with our underwriting, and didn't really change it much. So, that just shows character and discipline also from our side, I believe.
So we'll kind of switch to a little bit of a market overview. We invest in Texas. We did have the deal in Phoenix, but in Texas is our primary market. And for those of you non-Texans, we like deals, and we like the metros in the Texas Triangle. And the Texas Triangle is basically, a triangle from Houston to DFW, Austin to San Antonio, It's a booming economic center. The population is around 20 million individuals that live in the Texas Triangle, and it encompasses almost 80% of Texans. It has a $1.3 trillion GDP, and it is 6.3% of the total U.S. economy. Some people predict that by 2050, this is all going to be one huge metro area. I kind of have my doubts. I don't know if Houston people are going to want to be that close to Dallas people, even though we love our Dallas neighbors. This is just two different cities, two completely different cultures. I can definitely see Austin and San Antonio blending into one. I mean, you're already seeing a ton of development between the two right now, where the metros are just kind of starting to blend together. But by 2050, they're expecting the population in this triangle to be over 35 million people. So a little bit of a market deep dive. We're from Houston. We love our city. Over 7 million people, 1.5% population growth just last year alone. Major economic drivers are energy, healthcare, distribution, manufacturing. This chart here down below the picture, that was a recent Freddie Mac 2023 outlook. And they think that Houston is going to be in the top 10% of gross income growth, which that's definitely promising for our city. Definitely a lot of energy happenings and healthcare happenings all around the city right now. It's pretty impressive to see. You do notice out of those top 10, we are projected to have the highest vacancy, but I kind of want to point to these units under construction. There's been a lot of construction, especially in the urban core city where I live. Just tons of Class A resort style apartments that are coming online, and that's that definitely is negatively affecting the overall vacancy rate. But this is not really in the area that we play in, right? Where we're looking for B and C workforce housing class deals, and these rents are significantly higher than the projects that we work on. Overall in 2022, strong rent growth, 7% in C class, 16% in A and B space. And job growth in 2022 was 6.2%. So, when we're looking at a metro to invest in, we want population growth and we want job growth because our tenants are going to be able to find jobs easily, and so they can pay the rent. And so that's really important metrics. And that's like the two key metrics that we look. And the large metros in the Texas Triangle definitely fulfill that metric. We do own a property in Austin, and we're actively looking in Austin. Definitely smaller population than Houston, but more robust growth over the last year. They've added 2.39% just in the last year, and 33% population growth from 2010 to 2020. The major economic drivers in Austin, obviously tech, hospitality, manufacturing, and the Freddie outlook is a little different. I mean, they think that Austin, the income growth is going to cool just due to the tech slowdown. But from what we're seeing on the ground, I mean, maybe there's some tech slowdown, but just the population, the boom is so big there and the population is so small. I mean, the salaries for, let's say, our apartment teammates, leasing people, managers, maintenance guys, they're through the roof there, and much higher actually than Austin than in Houston. So I'm kind of doubting this number, but potentially their rationale is just the tech slowdown overall. And it's similar situation with the vacancy. You will see higher vacancy numbers, but as you can see, for a smaller city, 17,000 units. Some publications say even almost 20,000 units that are going to be delivered in 2023, and that's like 4.5% of their total apartment stock. So that we're going to see how Austin absorbs that much like newer deals at that price point. It's definitely going to be interesting to see. But just like we saw at our deal in Austin, robust rent growth, 11.6%. across all asset classes in 2022, and robust job growth, 5.3%. All these charts, as they're all from Berkadia, so these are not our charts. So DFW, like I said, we exited our deal last year in DFW, but we've definitely been getting more deal flow from there, and we're actively looking in DFW as well. Large diverse metro, over 7 million people, 1.33% population growth over the last year. Lots of corporate headquarters there, IT, logistics, construction companies. Again, lots of deliveries expected in the Class A space. Super strong rent growth in 2022, and as well as super strong, job growth in 2022. So our portfolio, we own right now 638 units spread between Austin and Houston. We at our deal Los Prados is 264 units, occupancy sitting around 87. The occupancy in Houston right now is around 90, 91. I would note that the lease trade outs, and for those of you that don't know what a trade out is, you know, when someone vacates a unit, maybe they're not renewing, or maybe we don't renew them, and we go in and fix it up, or you know, maybe fix it up minimally, maybe even do a little bit of a facelift on it. You know, we're getting a 10% lease trade outs and 10% on just straight renewals as well. So those are definitely strong numbers. And the challenges with this property have been some evictions. We've had a couple of skips over the last month, couple of evictions, so that's why we dropped below 90. But you know, we're in the process of releasing those units and turning them over. Sutter Ranch, you know, this is definitely our nicest property in the portfolio right now. A 92% occupancy, 10% trade outs, 10% renewals, and it's good to see that these properties are getting the same trade outs and renewals. And the challenges in this property has been the floating debt. As the interest rates went up, you know, we have to escrow for the next interest rate cap, and so that has been, you know, I guess that has been a challenge to escrow. I mean, not a challenge in that we can't escrow, but you know, it's just to have the cash flow diverted to the escrow account instead of to other accounts is never a positive thing. And Mueller City View, 138 units, occupancy now is at 91%, lease trade outs 12%. Just right on track with that 11.6% rent growth that we're seeing in Austin. Renewals at about 7%, and challenges that we had were construction delays. We rebuilt a building that was completely burned down, as well as the floating debt as well. So I'm going to quote my friend James Ng here. And for those of you that don't follow James, he has a great YouTube channel. Just search James Ng on YouTube. He gave I guess a debt update a couple of weeks ago, and he did give me permission to use this. I mean, it's waiting for a pause, and that's what investors, you know, GPs and LPs are waiting for. And pause, he means a pause in interest rate hikes. And what a pause is going to do is going to signal that inflation is cooling. It's going to, you know, stop the increase of the debt service and floating rate products. It's going to reduce the amount of, you know, cash that we have to escrow for future rate caps. It's going to reduce the 10-year treasury, so it's going to be easier to refinance properties. And the average rate cut is usually about 9 months away from a pause. So that's historically the data that multiple economists have cited. And overall, it's just going to reduce the uncertainty on business. So what are our plans? I mean, that's kind of what we're here tonight, just to discuss our plans and what we're looking to do in 2023. I'm seeing a lot of people pencils down. You see people, you know, on social media saying pencils down. And I contacted a guy who I know personally that said, oh, he's pencils down. I was like, are you really like not underwriting any deals? And he was just like, no, that's not what I mean. No, so they just mean maybe they're not putting in offers. They're working on operations, but they're still underwriting heavily, right? Because you're looking for trends. We don't have crystal ball, but we do know that, you know, the peak that everyone said was happening in 2018 and then 2019 and then 2020 and 21. Now we know that peak, you know, in 2023, we're kind of on the downswing, right? And so we're going to be looking for quality assets at a lower cost basis. We still see a significant ask bid gap. And for those of you that don't know what that means is, you know, what the seller of the property wants for the property and what the buyers are willing to pay, right? And a lot of that is determined by debt. You know, the rent growth is still there, but just the lending, the leverage, and the amount of leverage that you can get and the interest rates that you're getting are just not what they were last year. And so sellers still want 2021 prices, buyers want 2023 prices, and at this point, it hasn't really settled as where's the middle ground going to be. We're still going to look at C plus and B assets, and we're looking for distressed owners, not necessarily distressed assets. And what I mean by distressed owners is someone that their loan is coming due at the end of this year, and they either need to refinance or sell. Maybe they're having difficult refinances. And, you know, for those of you new to the space, a lot of times we can implement a cash out refi where, you know, we're trying to boost the income of these properties, hit a certain NOI, and then we go and we try to refinance it. And if you underwrote, let's say 70% leverage for that refinance, but the bank is only giving you 60, you're not going to be able to get cash out. And a lot of people are actually having to put cash in to refinance out of the floating debt, where you thought you were going to be able to cash out a couple of $1 million, but they're saying, oh no, we need you to actually put in 500,000 to do the refinance. So we're looking for owners that are faced with those situations, not necessarily distressed assets that need a building rebuilt from a fire, right? And we're going to strengthen our strategic partnerships in different markets. Our underwriting criteria is 1980s plus, vintage, 100 to 200 units. We need it to be at least a 14 plus IRR, 55K median income within the 3-mile radius, cap rates of at least 4.5. I mean, it's still common to see brokers sending us a 3 cap, and we're not even going to really waste time on that, just because we know that it's not going to work in today's market. We will look at sub 1980s deals if it's a very good pocket of town, and if it's greater than a 5 cap. And we need the economic vacancy to be less than 15%. So deal flow, you got to have deal flow, and we're screening at least 5 deals a week right now. We're going to ramp that up, but the transaction volume is just low, and the deal flow is much lower. I mean, at the beginning of last year, we would have like 20 deals on the deal board. Now we're lucky if we can have 5 or 6. We've met with several partners that have, maybe they have better deal flow than we have in Austin. And so we're looking for to strengthen strategic partnerships so we can get more deal flow in different markets. We're going to stick to our criteria, right? We're not going to be buying a 1980s 3 cap that's distressed. And, we're potentially entering the Phoenix market again. We're getting sent a lot of deals. We have really good broker relationships in Phoenix with some of the top brokers. We have general contractor relationships and property management relationships as well. So we're definitely going to, consider entering that market. That market is cooling, and it's a good thing. It had gotten overheated, and you're seeing a lot of negative, talk about it. And that's usually kind of, at least in our view, that's kind of when you want to start looking, right? We left it alone last year, minus the exit, and stopped looking at deals there because it was too hot. But then as it cools, we want to see, if they make sense, and we're getting sent a lot of 5 cap deals there, and so that hits our criteria. So development deal, we've been working on this development deal for, I think it's definitely over 6 months. GenWealth got the land under contract. It's 11 acres in Conroe, Texas, which is a booming city in Montgomery County. And Montgomery County is right now the fastest growing county in all of Texas. And to do that, we have strategic partners from DFW, the Revision Masters guys. They have 4,000 units in the development pipeline. They have 300 units going vertical in Katy right now, which we've toured the asset. And they have 6,000 units existing units that they've bought over the last 10 years. And so very experienced guys. We're really happy to partner with them. With development, there are risks in development, and especially the entitlement risk. So right now we're going through the entitlement risk process. We're getting approvals from TxDOT. We have to get approvals from the city of Conroe. And let's say, if we need to raise millions of dollars to buy this land, we need to have the permits in hand and all the entitlements green lighted before we go and raise investor money, because we're planning to build 240 units. But if we buy this land and the city or TxDOT says, no, you can only build 100, then that's not really going to work for us. So for us, we front all the upfront costs for this. We spend a lot of time. We've been spending a lot of time, talking to city, governing bodies and city services and TxDOT to get this right. And so we hope to have this ready to launch and finalize sometime by the end of the year. And really, that's it. I promised everyone it was going to be quick today, and it seems like it was about 27 minutes. If you haven't booked a call with our team, we do 506B deals and we do 506C deals. If we do launch a B deal, whether you're accredited or not, and we don't have the relationship, you can't invest in the deal, unfortunately. So, you can schedule a call with me from the website, from any of the emails that we send. Let's jump on a call. Let's start establishing that relationship so we can be documented, and to where if we do have a 506B deal, you're good to go. It's a seamless process. We are hosting monthly happy hours at my favorite bar, 8 Row Flint. They're kind of intimate happy hours, maybe 7 to 10 people. It's a mix between a couple of general partners, a couple of investors, a couple of brokers. We all sit around, talk shop. We had our first one this past month, and it went great. The attendees really liked it. We do have a monthly meetup that we're going to start promoting more. It's around the Woodlands area. It's the first Saturday of every month. So if you're free on Saturdays, we'd love to have you. It kicks off around 11 o'clock. Pretty informal. We usually have some type of guest speaker there within the multifamily industry. So we'd love to have you for that. And we are thinking about launching a new meetup somewhere in the Houston Heights area for people that live in the urban core, most likely during the week once a month. So with that being said, Juan, do you have anything to add?
No, just on the Woodlands meetup, we will be having a lender join us this coming Saturday, which will be the first weekend of the month in February. And he's a wealth of knowledge, and he should be a good meetup for anybody that can join us.
Awesome. So let me see. Do we have any Q&As? Does anyone have any questions? If you have a question about a specific deal that you invested with us, we can kind of get into much more detail on the phone. So we'd love to have a chat if you're invested in one of our deals and you have any questions about them. Just pick up the phone. We're a phone call away always. And if you have any general questions about just the direction that we're going in as a firm, feel free to type. And again, Oh, can I recap on the happy hour? Sure. Yeah, we haven't scheduled the next one for February. We just had one. It's at 8 Row Flint. I don't know if you know. I think it's the best bar in Texas. Personally, it's in the Heights. We have a table there, and so I can definitely, Peter, I can send you the info on that. We'll definitely invite you. Awesome. Thanks, Chance. Hey, well, thanks again, everyone, for attending and spending 30 minutes of your time with us tonight. We hope you have a wonderful evening, and we appreciate your support, and we look forward to doing business with you all and buying some deals in 2023. Thanks a lot, everyone.
Thank you.